Welcome back to another episode of Compliance Insiders. We're glad to have you back. It's been a long time, but I think this is the right time to pick it up again. And you'll notice we're doing video, first time ever. And with me is Floyd Drew, a mortgage servicing expert with more than 15 years experience. He's an attorney. He worked in previous roles at Fannie and Citi doing servicing and loss mit. And we're really glad to have you on, Floyd, because I think we got a lot to talk about today. With what is happening with the coronavirus pandemic, and our world has been turned upside down. Congress has acted pretty swiftly to try to help us, mortgage lenders and servicers, because we have a lot of issues to deal with, including struggling borrowers that we need to take care of. So you've been reading up on this, and you seem to have a lot of expertise and understanding about what's going on. So I'm going to turn it over to you. Let us know what's happening and what we need to know about.
Sure. Thanks, Roger. Really, three main provisions work towards the mortgage industry. There's also an eviction part of it that relates to it. But the three main parts that servicers and really mortgage companies in general and banks need to know about are one is related to credit protection, one is related to foreclosure moratorium, and one is forbearance. On the credit protection part of it, if it's a hardship related to the virus, then from January 31st through 120 days after there's no longer a national emergency related to the virus, there's certain actions that a servicer must take. If the borrower asks for forbearance or help related to the virus, then usually with a forbearance, they would go in default because they're not making their full payments. But the government is saying, no, if they're current when they ask for this assistance, then throughout the period of the forbearance, you continue to report them as current. If during this, they were delinquent when they asked for this, so let's say they were 30 days delinquent, well, you continue to report them as 30 days delinquent throughout the life of this, even though, as we'll talk later, it can be up to a year later before they make their full payments. And then lastly, if they are delinquent going into this and they become current, then you report them as current at that point. So because of the retroactive part of this, going back to January 31st, if a borrower has come in and asked for assistance related to the virus, you'll have to go back and correct that credit for them to comply with this.
Interesting. So there's already a lot of work. There's going to be a lot of new procedures in place just to deal with this. Because I don't think the computers and the software, the servicing software can maybe it can handle it, but I think there's going to be some changes that have to be made quickly in order to accommodate it. That's
definitely true. And looking back on the notes for these borrowers to see why they asked for this. So they have some work to do on that end. On the forbearance part of this, if a borrower says there's a need because of the virus, so they don't have to be in default. Again, they can be current and they ask for assistance, then they can ask for forbearance for up to 180 days. And then related to that, they can ask for an additional 180 days. So a total of 360 days of forbearance related to it, and no docs required on it. No documentation. They have to prove that they're having the hardship. They just have to attest to it. Wow. And related to that, the servicers cannot charge fees or penalties during that time as well. So you can't charge for the forbearance. You can't increase the interest rates related to it. They really are trying to make it so there's no harm to the borrower, either on the credit side or on the payment side of it. And then lastly, there's a foreclosure moratorium. Cannot initiate or move for the order of a sale between the time of March 18th to May 17th of this year. And there's no virus requirement related to that, but it doesn't apply to vacant or abandoned properties. Kind of further problem you'll have with that is determining whether it's a vacant or abandoned property. You better be sure. And the regulators and agencies have come out with some guidance, kind of numbing down what needs to be done for a property preservation check or a vacancy check because of the virus, because some people just don't want to go into a house and expose themselves to a potential virus situation.
That's right. And I assume also we're talking about non-judicial foreclosure states because the court backlogs right now for all types of matters, forgetting about just this, much more serious issues. I know they're already strained, and I know that, for example, just a court anywhere trying to assemble a jury pool is difficult. So, and I don't think having using Zoom to try cases is something that's on the horizon because there's a few constitutional due process issues involved with that. So, even if it was permissible to foreclose in a judicial foreclosure state, good luck.
Right, right, and just to make one point of clarity here as well. That's a good point. It's only related to federally backed mortgage loans, so it would be VA, FHA, Fannie, Freddie, USDA, and a couple of others. So you're going to have some confusion in the industry, right? If a loan is owned by a bank, or just it's not federally backed, a borrower's going to call in and ask for this assistance, and he or she may be told no, because it doesn't comply with the program. So there's going to be, there's going to be some confusion there. There's going to be some consumer issues there, and there's more likely going to be litigation related to that. Because even though it doesn't apply to, to those type of loans, doesn't mean it hasn't become industry standard at that point. And regulators will focus on industry standard when bringing this down. You may have a strong legal position, but you don't have a very good business risk position.
Yeah, that's right. I'm making notes while we're talking, and that was the first thing that popped into my head is what if it was originated as a non-QM loan for any reason, let alone DTI or LTV, what have you, or just alternate income is usually the source is usually the reason to make a loan non-QM. And so if that's a self-employed borrower, for example, and they had to come in through a side channel, and now all of a sudden their business is impacted, and they don't have any method to protect themselves. They are in much greater risk than someone who has a loan that was either sold or guaranteed by the GSEs. So that's a real consideration. And I wonder if Congress is going to step in and address that, because there's billions of dollars of loans like that out there, and those would be probably the most at-risk people we can think of.
They could. Now, there's a couple of ways that I could see them handling it. For instance, for the larger banks and a bunch of state chartered banks came out, and the governor of California announced that they said they were going to do things similar to this on their loans. So even if they're not federally backed, they would allow for streamlined foreclosures, cease doing foreclosures. However, there's an article just a few days after that announcement that came out with borrowers being upset because it's a forbearance. And that's what we have to understand. They're not waiving payments.
Right.
This is forbearance. And in time, they will need to be paid back. There's nothing in this that said the payments are due at the end of the loan. So what typically happens with the forbearance period is you have that delay for at this point, 360 days, potentially. Mm-hmm. 360 days, they haven't made a payment. And then a year's worth of payments due at the end of that 360 days. Well, the thought is, hopefully they get into either they can pay it, or there's some kind of other loss mitigation tool, for instance, a modification or something at the end of that. But it keeps people in limbo, and it's yet to be seen in the industry what's going to happen exactly.
And that's literally impossible to do for 99% of the borrowers. So there has to be some sort of modification where either the loan is extended or it's re-amortized with a higher payment down the road, something like that, because there's no way that people can come up with a balloon that's tens of thousands of dollars potentially owed, January 1st, 2021. It doesn't make sense.
Right. There'll be another wave of loss mitigation even after this forbearance plan runs out. Another way that a non-federally backed loan may be put into a situation where it's required to be have forbearance or loss mitigation. Servicers are going to have financial issues related to this. Even though a borrower may not be required to make a payment, the servicer is required to pass through principal and interest amounts, or not pass through, but send principal and interest amounts to the investor. Further, they're required to preserve the property. So things like paying taxes, paying insurance, mowing lawns, doing repairs, they'll be required to do it to preserve the asset, and those will be out of pocket. an article came out recently where one servicer and the MBA anticipated it could be up to 1 to 4 people asking for this assistance. And I believe the NBA came out with a quote of $75 billion of potential losses to the servicers. And
I don't think they can afford that.
no, that's
going to
definitely
knock
true.
them out without
Yes.
help.
There's already discussions with the FHA and other agencies to talk about a fund to help out the servicers on this point. With that, maybe it comes without strings or maybe it doesn't. But if it comes with strings, it could be something along the lines of requiring certain loss mit that would shoehorn those type of loans
Sure.
into this.
Sure.
But still a lot to be done. There's, nothing's definite at this point, but a lot needs to be done on it. The main thing for this, I just think servicers just need to be prepared. They're probably already seeing a ton of phone calls coming in. And even originators who haven't really done servicing, and they usually sell the loan before there's any servicing involved. They may be involved in this because the CFPB requires you to make phone contact within 36 days after a borrower becomes delinquent. Well, if you're not able to sell the loan for 2 months, all of a sudden that becomes an issue. You're also required to have a designated contact for the borrower and send out a written notice within 45 days after delinquency. So I think originators need to be prepared for that as it comes down, either by interim servicing or setting up their own servicing shop. Servicers themselves, of course, are already looking at this, but they're going to have to move people over to help deal with the large amount of call volume and the documentation volume that's going to come with this. What you don't want to do in this is to just react and not have a plan, not have projects in place, not update your policies and procedures to help deal with this, because even though that may put a Band-Aid on it today, it becomes an issue tomorrow, as we saw after the last financial crisis.
I am really glad you, excuse me, you brought that up, because that was my next question. We have a lot of viewers, a lot of listeners that are on the origination side, and they're just as concerned as everybody else, because they have to really carefully scrutinize every clear to close they have and make sure, is this a loan we can actually sell? On multiple levels. First of all, they have investors that are pulling products left and right. So all of a sudden they're being left out in the cold. They may have to decline a bunch of applications that they're literally clear to close because that product is no longer available. And you have a gigantic customer service nightmare, but you've avoided the scenario you're talking about. And you just have somebody who's really unhappy. Legally, I think I don't want to give legal advice here, but I think you could probably, in most cases, say if the product's not available, I can't see a reason why we can move forward with this, and it's permissible to decline the loan for that reason. You're going to have somebody very upset on the other end of the line, and it would be nice maybe to do what you can as a responsible lender and refund all of the fees that the consumer or the borrower might be out in connection with the application, appraisal, that type of thing. But for those loans that close and then a week later you get a call or a day later you get a call from the consumer, I can't make that first payment, or I can't make the second payment. And your investors are looking very closely at these types of things, and they say, well, we're not going to buy from you. Now you're a servicer, and many originators out there are not set up to be servicing, and they're going to have to coordinate quickly. If that means connecting with a company that specializes in servicing and working with them to handle that, or doing it yourself, it's going to get pretty ugly. It's going to get, I'm sure it already is for people on the front lines. And, we can only hope that this crisis ends quickly so that we can get back to normal.
Right. That's correct. And reaching out to the investors and talking to them ahead of time, being proactive, is really going to help you out on the originating side, or the servicing side for that matter, to have to know what your processes and procedures are going to be. What you don't want to do is have 100 loans in the situation you're talking about as an originator that you don't know what to do with, and you don't have an interim servicer or a process in place to deal with it, and you have an investor who's just closing the that outlet out to you. So hopefully companies are thinking about this, thinking ahead and getting ahead of it. Even with that, it's going to be a very difficult time right now for any originators or servicers to make sure they're complying with everything they need to comply with, just because things are coming fast and furious. We have the CARES Act just came down, but also we have state laws coming down. We have agencies giving input, and investors having their own input. I mean, we can read what Fannie and Freddie's doing, but we can't see what private investors are doing and what they're requiring people to do.
Right.
People forget, but before the last housing crisis, 2008, there just weren't many modifications. In fact, some servicing agreements and some charters for some of the government-related entities didn't allow modifications if you weren't in default, which that's changed since then. And but it's interesting also because at that time, forbearances were used very heavily, more than modifications. You delay things. Then with the housing crisis, those kind of went out. You had consumer advocacy groups and others, talking about it's just kicking the can down the road and creating a bigger problem, creating more, stress for the borrower because they don't know what's going to happen. And, the CARES Act focuses on forbearance, and others are focusing on forbearance right now. And it'll be interesting to see how that plays out, as this evolves.
Right. It's history repeating itself and very quickly. So it's going to be interesting to see how this works. So on the one hand, it is, I'm repeating what you just said. It's kicking the can down the road, so to speak, as long as this is something that's sustainable, the pandemic can last a long time. On the other hand, most people in our industry have lived through this before, something somewhat similar, and we understand what the response looks like. We also understand, and you understand very well, what the fallout looks like if you don't address it head on. It might just be setting us up for a very long-term, protracted recovery on the mortgage side and the housing side. So it will be really interesting to keep an eye on this, and hopefully people will be reacting much quicker this time than last time. And I think they will. To finish up, what takeaways should both originators and servicers alike and everybody else who's just listening, what should they be thinking about, and what are next steps?
Sure. And, related to these, there's also been some state rules coming down and guidance, things like that. So some of this will touch on that. But one, update your business continuity plans to include pandemics. Some states and some agencies came down and talked about how that should be included in there.
That's a great point.
Verify and make certain you have proper controls for privacy and security requirements, because you have employees working from home now, and be sure not to drop that down. The controls are very important. Review and update loss mitigation, foreclosure, and eviction policies, or for some, create them if you don't have them already. Review your servicing agreements with your investors, as well as we talked about discussing with investors about what they want you to do with these loans, whether you're servicing them or you just originated them. And then staff properly for borrower contact and loss mitigation. If you haven't received a bunch of calls, you will. And you need to be able to talk to them, as we talked about, within certain time periods. You have to reach out to these borrowers after a delinquency, some verbally and some via writing. You must have designated contacts within 45 days after a delinquency. And have controls and testing in place to ensure proper documentation and handling. This can happen a lot. Again, as we talked about earlier, you're trying to react quickly to these things, and you're thinking, okay, well, I'm trying to do the right thing here, so therefore there's little risk. Well, that's not true. As we've shown after the housing crisis, you can try to do the right thing, and still it's done the wrong way. You don't have the proper documentation. You don't document that they're part of that's a hardship related to the virus before giving this kind of benefit. And you can be hit with it later, either through claims from investors or through lawsuits from borrowers.
Wow.
Yeah.
Okay.
Yeah. It's a wild time. Not criticizing the forbearance plan. It's an efficient way of dealing with it right now and trying to come up with a different plan later. But it's to say it's going to. Servicers already know it's a difficult time, and it's going to be a stressful time for borrowers who are going to be suffering, because of this. And but hopefully, as you said, it goes away quickly, and we'll be back on track.
Floyd, this has been great. Thanks so much. And I want to have you on again because this is going to be rapidly evolving. And so we'll give some updates down the road and talk about what's happening next.
Are you a compliance insider? Then go to compliancepodcast.com immediately and join our mailing list so you never miss an episode. Got something to say? Request to be on the show. Go to compliancepodcast.com with your topic ideas. And as always, thank you for listening.